put your money to work. Real estate goes up and down. Gold goes up and down. Bitcoin goes up and down. Everything goes up and down. So knock it off and saying the stock market is expensive and it's risky. Give me a break. If you have a 30-year time horizon, which most mortgages have 30 years, then give me a break. In today's show, we're going to talk about the dirty truth of real estate. And I want to start off just with the core idea of investing in property. It could be land. People talk about land all the time. One reason I don't like land, it's one of the few investments that cost you money. Do you own land? If so, you know what I'm talking about. It's as simple as this, that when you invest in land, you have to pay for maintaining the land and still annual insurance. And lastly, property tax. You're sitting there with an asset that's providing no income. On the contrary, you're spending money on an annual basis in hopes and in anticipation for it to appreciate in value. So I don't like that as an idea. To me, that's not a good investment. Now, when you put that into context of residential property, which most people, 9 out of 10 that are invested in real estate is residential property. It's funny how everybody thinks they're a real estate mogul. Some people are crazy enough to have properties where they lose money on a monthly basis and are excited and proud to hold this property. This is the problem. That isn't a dirty truth. That's just pure stupidity. You don't invest in something to lose money on a monthly basis. I'm going to use a core example of $500,000 property. Doesn't matter where you are in the country. Most people, for an investment, you would have to come up with 20% down, unlike a primary resident where you can maybe do an FHA loan with as little as 3.5% down. But let's focus on that 20% down on $500,000. That is $100,000 down. Why is that important? Well, because you're going to be financing at roughly $400,000 at what we're going to call 6%. By doing so, you're going to have a principal and interest payment of $2,400 a month. Now, some people think that's all that matters, and maybe you can get $2,700 a month in rent. Let's call it $2,750. Okay, so you may be thinking from afar, you're netting $350 a month. Not so fast. Let's look at the other expenses that people don't take into consideration. Number one, property tax. There could be some states, like the state of California, on a $500,000 home in Los Angeles County, could be $500 a month. So just like that, you're at $2,900. Insurance could be $150 a month. Heck, you could be near fire or flood zones that could even be more expensive than that. Let's continue on the conversation because, by the way, that alone, if you just have those 3 core expenses, your mortgage payment, property tax, and insurance, you now have over $3,000 a month in charges, $3,050 to be exact, and your income is $2,750. You're negative $300 a month. That $300 a month is $3,600 a year. You put $100,000 down to lose $3,600 a year, that's a negative 3.6% cash on cash on your accounts, on your investment. And oh, by the way, that assumes everything goes right. That sounds like crap, doesn't it? It's because it is. Now let's add more crap on the crap. What you also could have is vacancies. Oh yeah, folks, the average nationwide vacancy is 33 days. You just lost 1 month of interest or mortgage payments. Rental income. You lost 1 month of rental income. That's a problem. Continue the conversation. When you have repairs, on average, for people who have real estate, you already know this. It's the 1% rule. Your house is worth $100,000. 1% of that, $5,000 is going to go towards repairs that year. That's just what it seems to be. And for somebody who has rental property, I would agree with that statement. Continuing the conversation, you might be covering gardening because you don't want maybe tenants who don't care to not care about the gardening. And of course, maybe pool maintenance if applicable. And we're not even talking about homeowners association, HOA, which not all properties have it, but most properties do. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth, here on every weekend, talking about all important topics of personal finance. And today I wanted to go over with you this real estate game that people are saying is a no-brainer to do. And they always give you the misconception that you're going to make money, do cash out refinance, and go buy more. But here's the thing. What people don't understand is that you have a time element. They consider real estate investing passive, which means you don't do any active work. But you know what feels like active work? When there is a flood, when there is a plumbing problem, when there is a roofing problem and a leak. There was so many times that things just don't work. It could be a refrigerator, a washer and dryer, any appliances at that. You're in charge to actually have to fix those. Now, here's a cool hack that some people may not know. That is, you could get a home warranty. It might cost $800 a year to do so, which, oh, by the way, is an additional expense. But that $800 a year, you can have the tenants actually be put on there as somebody who can call in and for a repair. And this could be an electrical repair, AC repair, a plumbing repair, whatever the case may be. The tenant calls them, schedules a time where you don't have to be there in the middle, and you can actually delegate that responsibility to an insurance company. Oh, by the way, property managers typically charge anywhere between 5 to 10%. On a residential home, it's typically 10%. On $2,750 a month, that's $275 of additional expense that you're going to have to pay for. And oh, by the way, they're going to send somebody to fix it, and they're going to bill you for it. So does this make sense? Because when you run the numbers on this, it's all negative. The cash flow just starts compounding negative, negative, negative. The $5,000 a year in expenses on average, well, that's roughly $400 a month. Add it to the list. The gardening, if applicable, HOA, if applicable, and the pool, if applicable, all matter and compound to make it potentially less than $1,000 a month in negative cash flow. So why the hell are people doing this? This is why I'm shocked that real estate is still valued where it is. Because when you look at real estate prices today, the cost of renting is actually cheaper than home ownership. So why are people buying? Well, I think that's a fair question. And the logic behind that is very simple. When you buy a house, especially if you're living in the house, well, your payment is locked for a set period of time. Principal and interest. And oh, by the way, you can always refinance if interest rates go down. Remember, this analysis was done at 6%. There's people I know that have a 2.5% that they did a few years ago through refinance. And oh, by the way, our government said they are looking to lower interest rates. So there could be a refinance opportunity in the future. Also, there are tax benefits for having a home. Now, if it's your primary resident, depends if you itemize, but if it's a rental, you will always write off the mortgage interest. There is no threshold for standard deduction there. So you, in fact, get to write that off, which is a tax benefit. Speaking of tax benefits, there's also value in depreciation. You get to write it off, which offsets your income. Why is that important? Because you essentially get rental income that is tax-free. And then, of course, you have principal buy-down. Every month on your $2,000 payment, the $2,400 payment, I have to look what that was in my notes, about $800 to $1,000 of that every month is going towards principal reduction. Every month it actually goes more and more towards principal reduction. This is a key element that often gets overlooked. And when that happens, that $800, that's roughly $10,000 a year that you don't have in your pocket, but it's through not appreciation, but equity that you build in the house as you are in fact paying down the loan. Sure, it may take you 30 years, but the logic with all of this is this has to be calculated into it. The tax benefit, the positive cash flow, and of course, the principal pay down are all mechanisms that's important. And one thing that's sometimes difficult to gauge, depending on where you are in the state, is the appreciation of the property. The appreciation of the property is the real deal. In some states, it's more than others. But the idea is this is icing on the cake. But when you're deciding if you should invest in a real estate property, the first rule is very simple. Make sure it cash flows. And the reason everything is so annoying right now is because not everything cash flows. What tells me, for someone who invests in real estate, that it's too high. Especially as now you're seeing with more vacancies on the market, the price of rents are in fact dropping. So this is good for renters. This is not good for investors. And you're seeing more homes on the market now because it just doesn't make sense mathematically. And the only buyers that are smart right now are those who are looking to buy to live in it. If you're going to be in there 7 to 10 plus years, you're probably going to come out ahead. But as an investor, I sure hate putting $100,000 down and losing conservatively $3,600 a year with a negative 3.6% cash on cash return. The professional term for that is crappy. It's a crappy investment. So what we're going to do is we're going to go on a quick break. And when we come back, we're going to talk about what good investments look like and why people are starting to transition to alternatives. We'll be right back after a few words. Welcome back, folks. Here we are talking about real estate. And we were discussing if it makes sense. And we went over the first segment of today's show discussing the numbers of real estate. And even though people love it, real estate investments, they say you can't lose. They don't talk about the 90s. They don't talk about early 2000s. They don't talk about the massive drops of 40% plus in certain regions, even more from 2008 until it bottomed out in 2011. They don't talk about that. Why would they talk about that, right? Because they have, amnesia when it comes to losing money in real estate, just because they don't see it all the time. Everything has risks. Every property has its issues, and it costs money over time. Now, I'm not here bashing real estate. I told you earlier, I own real estate property, and I own rental properties, and it makes sense on so many different levels. But that was then, this is now. People sometimes say, hey, I bought real estate because you told me it was a great idea. Yeah, but that's when I saw you 3 or 4 years ago. Well, now the uprun is so much, interest rates are so much higher, it maybe doesn't make sense to do. So yet again, just because somebody told you something, you don't stick. It's not a core lesson in life when it comes to investing. You don't stick onto something when somebody says you should buy this or that you do that for life. It doesn't make sense, and it doesn't work that way, because what's good today may not be good tomorrow. And markets change. They adapt and they move. And you have to be able to adjust accordingly. Because right now, if you were to invest in real estate for the longest time, this may not be the best time to do it. And that first segment tells you why it's not. So let's focus on what you should be looking at and what you should be doing to discover what's a good investment from a real estate point of view. I like to talk about, if you're using leverage, the 4% rule. Now, what's the 4% rule mean? Well, in the example I gave earlier, where if you have a mortgage on a property, 20% down, and you are getting that $400,000 loan at $2,400 a month, and you add property tax and insurance, and your total cost is $3,000 a month, $3,050 to be exact, you want to have at least 4% cash on that $100,000. Remember in the example I had, it was $2,750. Not a good investment. You want to get positive cash flow of 4% for that to make sense. These are the things you need to look at. And this is what people don't want to tell you. Why? Because they don't want smart investors out there. They want stupid investors out there. Who wants more competition when it is actually a good time to buy? They would rather have you buy now, because now it's not a lot of competition to buy, because it doesn't make sense to buy right now, depending on the property. And the properties that are good to buy, they are competitively priced and they sell. But the 4% rule needs to be everything, net of all expenses. And then on top of that, you can add the appreciation of the home. But that's anticipated. So realistically, you could add the tax benefits. Realistically, you can add the principal buy down. But the goal and the first step is that 4% rule. That's how you determine it. Because you got to think, if you in fact get the principal buy down, the tax benefit, and you get the cash on cash return, excluding the appreciation of the property, you're probably going to get close to that 10% return. So what's the whole big deal here? Because it doesn't feel passive when you're getting calls in the middle of the night and people are asking questions, saying they're getting alerts from the city because they're not cutting their grass. That doesn't seem passive. You know what is passive? Doing nothing, putting your money in the S&P 500, collecting a 2% on average, what the S&P 500 pays out in dividends, and doing nothing. You get the 2%, and then on average with that is a 10% annualized return over time. Now, there's no guarantee. Let's have it in the past based on future results. But when you look at how much time that you spend doing nothing with the stock market and doing something with real estate, it's a big difference. The whole question is do you value time? Then you really have to consider revisiting your real estate. I know it's comfortable for you. I know it worked out well, but does it make sense? And people say, well, that's why I invest in gold. Well, gold, there was one time it lost 30+% in 2008 and 9 area. There's a point at the time it lost money even in the 80s. So we're in a cyclical spot right now where sure, you could have made 40% from January to now. But what now is when you want to buy? After the uprun, what, you think it's going to go up another 40%? Like, is that really what you're telling me? It's going to go up to 1,600 more points per ounce? 1,600 more dollars per ounce? $5,600 an ounce? Is that really what you're telling me right now? Like, let's be real. Self-assess. Stay disciplined. If you want the best investment option, this is where you have to look at diversification and get outside of your comfort zone. By the way, folks, if you're just joining, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every weekend. We are talking about all important topics of personal finance. Today, I want to talk about the housing, not crisis, not boom, not anything, housing situation, and what makes a good investment in the housing market. Sorry about that. For those who are seeing me on the YouTube, I have a little allergies here. I keep rubbing my nose. But the idea is that now you have to look at the opportunity costs of investing and investing in something, and keep that threshold of the S&P 500, something that pays roughly a 2% dividend and has an average return of 10% a year. That should be your basic step. I'm not telling everybody should be investing in the S&P 500, go and putting 100 grand in there. I don't know if your liquidity needs, I don't know your risk tolerance, I don't know any of that. But to say that real estate is less risky than the stock market, quite frankly, I think is bullshit, because it can cost you money. It could cost you 50 grand. It could cost you a new roof. It could cost you a new AC. It can cost you new electrical, new plumbing, new everything. Like, you don't know. And on top of all that, what? You don't get rental income? And most people don't even do the insurance right on the property when they get a rental income. It's not going to pay for loss of use for the tenant. It's not going to pay for their hotel. It's not going to pay for a different property. These are the type of things that people just don't take into consideration. Real estate is a liability. You can get sued from that. Find me somebody who got sued for owning the S&P 500. Yet again, some may say I'm biased, but you know what? I walk the walk, I talk the talk, I've done. And I've had the rental properties, I've had the stock market, and I'm telling you what has made more, what's been less of a headache, and what's easier and more liquid at any given time. And that answer is the stock market, which is why it's the number one asset class that's out there. And people like to focus on the Bitcoins and the golds and all this other stuff out there. But when you stretch it out over a 100-year period, let's be real here, folks. It has the less risk, best return, most liquidity, and no headache. And when I say no headache, I'm talking about the calls in the middle of the night. Sure, the market can drop. There's been a 12-month period where it dropped 40%. I get it. But assess your situation, get your head out of the clouds, and focus on things that maybe make you uncomfortable. And that's sometimes the key to success, is getting comfortable with things that make you uncomfortable. And so the whole logic with this is assess the basic threshold of investing, and that is the U.S. stock market, S&P 500. And if you're concerned saying it's too risky, give me a break. I don't accept it. Because as long as you go to work to make money, or if you're retired, I don't care, maybe your kids, somebody you know works, don't give me that. As long as they go to work to make money, that's capitalism, and the market goes up. And companies are in business to make money. Not only you or your kids or whoever that are going to work for a paycheck. That's how it works. It goes up. For that logic, people want to grow, people want to have more money, and people spend. With that simple logic, if you believe in those core characteristics, then don't be naive. Put your money to work. Real estate goes up and down. Gold goes up and down. Bitcoin goes up and down. Everything goes up and down. So knock it off and saying the stock market is expensive and it's risky. Give me a break. If you have a 30-year time horizon, which most mortgages have 30 years, then give me a break. At least it's not going to cost you money. And by the way, you're saying it could drop? So can real estate prices. Real estate can't drop? How about you talk to me about the people that invested in a whole bunch of real estate from 2005 to 2008? Give me a break. So focus on your future. Help run the numbers to make sure it makes sense on that 4% rule I told you about. And if you need help with that, reach out to a professional. This is what we do on a daily basis. We got offices all across the country. Reach out if you need help. We'll give you 1 to 2 meetings, 1 to 2 hours at no cost. And this is what people should be taking advantage of. Because for us, you already heard what I had to say. I told you, I have real estate. It could make sense for you, but you got to run the numbers. You got to be disciplined. It can't just be your neighbor's house that may or may not make sense financially. Emotionally, it may make sense. You may you may have enough money where you can piss it away so you could choose who your neighbor is going to be. That's your prerogative. All I'm focusing on here is what makes financial sense. And for me, I don't care about anything outside of making money. No emotional ties. What I mean by that is I don't care about the politics behind it. I don't care about the people behind it. I don't care about anything about it. No problems. I care strictly about how it puts more money in your pocket. Folks, that's all I got for you today. Hopefully you enjoyed the show. That was a fast show. Want to own real estate? Well, here's the dirty truth, is that it's not all cracked up as you would think it is. I'll make it very clear. The stock market does 10% a year returns. But when you look at what happens in real estate and you look at what's happened in the past versus the future, you're only getting part of the story. Even if the market appreciation happens, what has happened in the past 10 years, even if you look at the market appreciation that did happen in the past 10 years and extrapolate that forward, they're not telling you some of the biggest problems real estate can have.